Jonathan, it's great to have you back on. The last time we spoke to you, it was actually the beginning of the month, and you had mentioned that you're not making any radical changes to the portfolio amid the sell-off. It was just a couple weeks ago, but really it feels like a lifetime ago, given what we've seen with both the coronavirus outbreak and then, of course, the moves in the markets. Is that still how you're viewing the portfolio?
Good morning, Morgan. And first, I appreciate Mr. Gorman's comments and his release. I think that those are very thoughtful. And one of the things that many of your guests this morning have been talking about, all our hearts going out to those that are affected. But I want to thank in LA County all our public health workers and all our first responders. As it relates to our portfolio, we are sticking to our investment beliefs, our ideals. We continue to rebalance. It's something that we have to steel ourselves, and we had a board meeting earlier this week where we spoke about this. It certainly is very challenging, but having strong principles are certainly, these are the moments where we need to stick to them as opposed to allowing emotion to dominate our actions.
What does rebalancing look like right now?
Rebalancing, well, effectively, what we do on a daily basis is look at, we have a target asset allocation where we divide assets between 4 different categories of growth, real assets, credit, and risk mitigating strategies. And we compare where our balance is compared to what our target allocation is. And then with our available reserves, we look at rebalancing from the most overweight to the most underweight asset category. And thus far, this month, it by and large has been allocating out of risk mitigation strategies, things like investment-grade bonds, into equities. Now, on many days, it hasn't worked, and it's very difficult for any investor to try to either top or bottom tick a market, but over time, we believe that this is the winning strategy.
Jonathan, it's Kelly here back at headquarters. How much of a blow has the low-rate environment been for trying to fund the retirement plans of LA County employees? And, how much do you realistically think investment returns can close that?
That certainly is the question, and it's something that the investment team at LACERA and our board, we spend an infinite amount of time discussing. If you compare to, it's quite topical given the capital market environment we're in today compared to the last major crisis in 2008. Compared to 2008, portfolios have become more complicated as a result of the extraordinary measures that the Fed took post-Great Financial Crisis. Our portfolios are, by and large, more illiquid. Our portfolios aren't the historical 60-40 portfolios. Going forward, I think our portfolios may change the next time plans like LACERA go through our strategic asset allocation. They may change once again to try to factor in the lessons learned from this crisis that we won't know for some time. But I think that there are areas that may benefit, and we may need to increase our allocations to things such as infrastructure. Because, for example, it's become quite apparent our dependence over the last 6 weeks on broadband and internet connectivity. And not just, we've all been using and focusing on applications like video conferencing that ride on top of it and telemedicine and distant learning, but we need to focus on the energy and the infrastructure, the data centers associated with it. So at LACERA, we try every day to maximize long-term returns, to manage risks, and to make sure we have sufficient liquidity in order to meet those challenges. And they certainly are challenges, but one, I think that we've got the best team we've ever had at LACERA, and I think that we're prepared to fight that as best we can.